Hey, what's going on everybody? Dustin here. Welcome back to the channel. And in this video, we're going to take a look at dollar cost averaging and what it is and why you should be using dollar cost averaging to invest your money. Now, when it comes to long-term investing, there are a couple different ways to invest your money. One would be with lump sum investing, which is a chunk of money you invest all at once, or incrementally and consistently add money to invest over a period of time. And the benefit to lump sum investing is you put all your money in at one time and you get all that money working in the market sooner for you. And you don't have to worry about adding money later on. But by investing your money in a lump sum, it can be more risky since you invested all that money at one time. And if the market were to decrease, then all the money you just put in would decrease as well. Now, on the flip side, if the market were to increase, then obviously you're better for it since the money you put in would increase as well. But if you aren't excited about throwing a large chunk of money into the market all at once and accepting that higher risk, then you can lower your risk by adding it in incrementally to the market. And the incremental investment of money leads you to dollar cost averaging. Now, dollar cost averaging is where you invest money on a regular schedule. It could be every paycheck, every month, every quarter. But the key is that you're adding money in consistent intervals regardless of how the market is performing or the share price of a particular stock you're looking at. And if you have a 401k at work, you're already using dollar cost averaging because the money that's taken from your paycheck every pay period is invested into the investment that you've selected for your 401k regardless of how the market's performing. And you can do the same exact thing with other type of investment accounts as well. Now, by adding money on a consistent basis, it can help reduce your risk and lessen the impact of market volatility. And even better, you may be able to set up automatic investments to help reduce any potential human interference due to emotions. Because if the market's going up, you may consider waiting until it drops to buy more, or if it is dropping, you don't want to buy more before it bottoms out, right? Because you could possibly snag more shares if you just waited a couple more days. So this really removes us from the equation, who's likely our biggest enemy. And I have totally been guilty of this myself in the past. So automatic investments, it helps keep me from making stupid decisions and keeps me on track. Now, if you're enjoying this video, then give this video a like. It helps others find the channel and it's a free way to support the channel as well. Now, the funny thing about the stock market is that it goes up and down. Even though some people only believe stock prices go up, that's really not true. But by buying at different times, you're going to capture those roller coaster moments of the highs and the lows. And this can really work out in your favor because when you buy at different times, this can help reduce your overall cost per share. And when you can lower your overall cost per share, anything above that average means that you're making money. Even if you bought at a higher cost per share 1 month, the overall average might be low enough to where you're still making money. But let's take a look at an example where we're going to be investing $1,000 per month over the next year into the Waller's Wallet Index. So we're going to have ourselves 12 different purchase periods. And in month 1, our share price is $121 per share, and we buy a little over 8.25 shares. In month 2, our price increases to $125 per share, so we're able to buy an additional 8 shares. Then we see a rough patch where we see 4 months of decline and the price drops from $122 per share all the way down to $108 per share. Then we start to see the market rebound with 5 months increases going all the way up to $127 per share. Then again, in our last month, we see a slight dip with the share price being $124 per share. Now, over the course of this time, we invested $12,000 and we bought a total of 101.59 shares with an average share price of $118.12. So when share prices are above this average overall, we're in the green. And as you can see, the number of shares we bought at one time range from about 8 all the way up to 9.25, depending on how this index fund was doing at that time. But if you had invested all $12,000 at once at the very beginning, you would have bought 99.17 shares. So by using dollar cost averaging in this example, you would have just about an additional 2.5 shares, which may not seem like a whole lot, but if that happened for 5 years, that's an additional 12.5 shares, which definitely adds up. Now, to calculate your dollar cost average, it's actually pretty straightforward. you can take the total amount of money that you contributed and divide it by the total number of shares that you purchased. So for our example, it would be our investment of $12,000 divided by 101.5889 shares, which gives us our average share price of $118.12. But is using dollar cost averaging actually better than using lump sum investing? Now, I like dollar cost averaging and I think it's a great strategy to help reduce your risk. But there is some data that shows that using lump sum investing could actually produce better return in particular cases, because you're putting your money to work right away instead of slowly adding it to the market, because cash isn't earning you anything, while investing it has historically produced gains even with the potential volatility. And this Vanguard study from 2012 had shown lump sum investing could actually outperform investing with dollar cost averaging about 2/3 of the time, and it looked at 10-year periods all the way up through 2011. And while their main data focused on a 60-40 split of stocks and bonds, their 100% stock data showed similar results. But this study looked at investing a large sum of money, which may or may not pertain to you. And I remember watching this video a while back of Jack Bogle where he was actually talking about lump sum investing. And in his example, he said if you were to receive $1 million from your aunt, putting it in all at once into the market would be a better move than trying to spread it out over a period of time, because having that money sit as cash, it does nothing for you. Another time where lump sum investing could be better is if you were to invest a large chunk of money when the market drops, because then you would be buying a lot more shares for a lower price. Now, dollar cost averaging is a great strategy to help reduce your risk and make sure you invest consistently without trying to time the market or let psychological factors impact your investing strategy. And even in our example, you can see how dollar cost averaging can really benefit you as you make your contributions and how it can reduce your overall cost per share as well. But by making consistent contributions, you're going to get to take advantage of buying shares at a lower price point that's going to offset the times you buy shares at a higher price. And it's also going to help reduce your risk, because you don't know how the market's going to perform throughout the year. And while there is the possibility lump sum investing could be better, the timing of when you invest that lump sum, it's going to play a big part. Because if you invest that money right before a crash or right before months of negative returns, then investing in a lump sum, it could actually hurt you. But if you somehow invest it at the right time when the market's low or the share price is low of the fund you're looking at, then I guess it could work out for you. But trying to time the market, it's never a good thing. Now, if you do come into a large sum of money, either from an inheritance or maybe a big work bonus, then the data does show getting that money into the market sooner could potentially be more beneficial for you. But this all comes down to your risk tolerance. If you don't want to risk putting a big sum of money in the market all at once, then split it up and take advantage of dollar cost averaging to help reduce your risk. And at the same time, not everyone has large chunks of money to throw into the market all at once. So let me know, do you use dollar cost averaging or do you use lump sum investing? Now, if you're someone trying to become a tax-free millionaire, then be sure to check out this video right here where I tell you how much you need to invest to make that happen. And I bet it's lower than you think. And if you know someone who would find this video useful, then feel free to share it with them, and I'll see you in the next one. Take care.